Well, yeah, so I think that the key drivers, obviously, of the market, particularly the reflation trade, which has obviously caught a lot of attention over the last couple of weeks, is first, obviously, the vaccine rollout has been incredibly important, right? In terms of showing us a pathway forward, and obviously Boris Johnson last night detailing that for us here in the UK. The second is that obviously the Democratic controlled government has driving forward much larger fiscal spending than would have been anticipated in a divided government. So the outcome of the election is significant, and the Democrats continue to march forward with that. And lastly, and I think it's not insignificant, is this idea about the pent-up consumer demand, right? Consumers are waiting to get out there and spend money, and it seems like, particularly compared to last crises, they have much more money. And so that's obviously been a significant driver of yields higher, and as you mentioned, the yield curve steeper, which makes quite a lot of sense, actually, because we're not in a situation where policy rates are going to be moving higher, but rather the quantum of QE may be adjusted going forward. So for investors, when we look at this environment, what we would note is that real yields, so yields after inflation, have moved higher, but not significantly so. And so for us, actually, we look at moving out of credit into equities and look at fixed income as having a more challenged environment going forward, and actually have moved underweight government bonds over a tactical horizon.
Is there an element of tilting at windows, of windmills here, Scott? I mean, everybody has moved to this reflation bringing inflation story, and expectations have moved lockstep. And yet when you look at the pass-through from input prices to CPI, doesn't feel as though it's really showing up in the CPI numbers yet, the consumer price numbers.
Yeah, but I think also we have to keep in mind that this crisis and the return to activity is something that is incredibly unusual, right? This is not your normal business cycle, and so some of the rules that we would apply to that don't really apply in this case, right? We have a very visible shock. We have a huge amount of stimulus being put to the problem. To keep that in perspective, right? We think that the economic impact of the COVID crisis will be about a quarter of the economic impact of the global financial crisis, but the stimulus is something like 4 times more. And so, when we try and apply a kind of a cyclical kind of rule book or game plan to this crisis, that I think misses a lot of the important aspects. And one of them is this idea that the economy will really come out of this very aggressively. And that leads to things like reflationary trades, which is why we maintain this view around break evens, even though they've moved quite a lot. And why we think that rates can still sell off from here. Again, not dramatically so, right? We saw the ECB yesterday reacting to the move in, you were mentioning Euro bond yields. And so there's a kind of a very fine, a very intricate dance here that's going to go on between the central bank community and the market as yields begin to rise to keep them kind of in control, but consistent with the economic activity that we're seeing.